think investing is complicated, that you need insider secrets or have to watch the market 24/7. Forget all that. The most powerful investing strategy for beginners, especially right now in 2026, is actually simple, repeatable, and yeah, a little bit boring. But it works. So, what is it? It's all about systematic, long-term investing in diversified index funds, powered by automation and a whole lot of patience. Let's break it down. First up, diversification. Don't put all your eggs in one basket. Instead of betting on a single company, you want to spread your investment across hundreds or even thousands of them. Index funds and ETFs make this super easy. By owning a tiny piece of the entire market, you're protected if one company hits a rough patch. It's not about avoiding all risk, but about preventing a single failure from derailing your entire plan. Next, and this is a game changer, is automation. Set up automatic transfers from your bank to your investment account. Every week, every 2 weeks, whatever works for you. This takes emotion completely out of the picture. No more stressing about whether it's a good or bad day to invest. You just do it consistently, which is how you capture long-term growth and avoid the beginner trap of trying to time the market. Simplicity is your best friend. Forget the hot stock tips from your cousin, ignore the flashy charts on trading apps, and definitely don't get your advice from social media hype. Those things are designed to make you act on impulse, and that's where mistakes happen. Stick to a few core investments you understand. For most beginners, a simple S&P 500 or total US stock market index fund is a fantastic starting point. Now, this strategy requires one crucial ingredient: time. The market will go up and down. There will be scary headlines and uncomfortable dips. Your job is to stay calm and stay invested. History shows us that over the long run, the market recovers from every downturn and continues to grow. Don't panic and sell. Instead, see those dips as opportunities to buy more at a discount. You should check in on your portfolio, maybe once or twice a year, just to make sure everything is on track. But don't tinker with it. Your goal isn't to react to every bit of news, it's to remain consistent. Ultimately, it all comes down to mindset. This strategy isn't about getting lucky. It's about letting the market work for you and harnessing the incredible power of compounding. Small, regular investments grow into something massive over time. It might feel slow at first, but this disciplined approach builds wealth steadily, reduces stress, and creates financial habits that will serve you for life. So, if you're ready to start building real, long-term wealth without all the anxiety, this is the way. Thanks for watching, and don't forget to subscribe for more simple, effective financial tips. Once you've taken the first step and implemented a simple, disciplined strategy, the real work begins, but it isn't what most beginners expect. The challenge is psychological, not technical. Market fluctuations will happen. Some months will feel exciting as your account grows. Others will feel discouraging as values dip. The key is understanding that both are normal and temporary. Volatility is not the enemy, it's the cost of participation. Beginners often panic during downturns, selling at the worst possible moment. Experienced investors understand that downturns are temporary and are offset by long-term growth. Accepting this reality before it happens removes emotional decision-making, which is often the biggest threat to wealth accumulation. Consistency continues to be your greatest ally. Automated contributions mean you keep investing, regardless of market conditions. Over time, the benefits of compounding become visible, even if growth feels slow at first. Watching small, regular investments accumulate builds confidence and reinforces good habits. Another challenge is temptation. Social media and financial news often promote hot tips, speculation, or fear-driven narratives. Beginners must filter out noise and focus on their own plan. Deviating from the system in search of quick gains is a fast track to mistakes and regret. Discipline, not excitement, is the path to success. It's also important to celebrate small wins without losing perspective. Seeing your account grow gradually is encouraging. But remember that temporary gains or losses do not define your progress. Instead, evaluate your success by whether you stick to your plan through both good and bad periods. Risk management is simple. Maintain proper allocations, avoid impulsive trades, and regularly rebalance if necessary. This prevents overexposure to any single asset or sector, maintaining the stability and predictability that make beginner strategies effective. Finally, adopt a long-term mindset. True investing success comes not from timing or clever tricks, but from staying invested, leveraging, compounding, and allowing time to work in your favor. Every month, you remain consistent. You gain a slight advantage over those who start and stop, chase tips, or abandon plans due to fear. By understanding the emotional journey, practicing discipline, and remaining patient, beginners position themselves to benefit from decades of market growth. Over time, this transforms not only account balances but confidence, decision-making, and financial independence. Staying invested, isn't just a strategy, it's the mindset that separates successful investors from those who never fully participate.